This is the Moody's conference or session. So I'm going to introduce the presentation. This is on state and local government update on environment and environmental risk. Today we have three different presenters: Roger Brown, Matthew Butler, and Ken Surgenor. Roger Brown is the Vice President, Senior Analyst, and Manager for the Dallas Local Government Ratings Team. He manages a team of analysts covering credits primarily in Kansas, Louisiana, Missouri, New Mexico, and Texas. Prior to joining Moody's, Roger was a Senior Vice President and Credit Risk Officer at JP Morgan and Chase Bank. Roger holds an MPA from Indiana University, an MBA from A&M University, and a BA from Emory University. Our second presenter is Matthew Butler. He is a Vice President, Senior Analyst on the U.S. State Ratings Team. He is lead analyst for several states, including California and Pennsylvania. He spent over 7 years as a local government credit analyst and was previously lead analyst for the cities of Chicago and Detroit, as well as others throughout the Midwest. Prior to joining Moody's, Matthew was a budget analyst for the state of Michigan and an analyst with the Governmental Accountability Office in both Washington, D.C. and Chicago. Matthew holds an MPP degree from the University of Massachusetts and an undergraduate degree from Michigan State University. Ken Surgenor is an analyst from the Dallas Local Government Ratings Team, covering credits primarily in Missouri and Kansas, Louisiana, and Texas. He is the lead analyst for Missouri local governments. Ken also serves as the Enterprise Risk Task Force. Prior to joining Moody's, Ken worked for the city of San Antonio in the Office of Management and Budget. Ken holds a master's in public service and administration from Texas A&M University and a BS from the University of Texas at Dallas. I'd like to thank Moody's and all our presenters, and you have the floor.
Okay, thank you. This is Roger Brown. We're so excited to be presenting to y'all today. We were kind of thinking about, what are some topics that might be of interest to y'all today, especially in light of everything going on this year with the coronavirus, the pandemic. We thought and I'm just going to start here on the first maneuver. The first slide. Matt will begin with a state level update, and then Ken will follow with the local government credit landscape. Be talking about a little bit of trends, some national trends, and then some sales tax trends. Some are probably a little bit actually surprising compared to what some folks thought back in the beginning of the pandemic. Then I will conclude with discussion about environmental risk framework. This is I think about 3 weeks ago, there was a presentation by our Moody's affiliate 427 talking about a high level environmental risk framework. I'm going to actually bring it down to more of a micro level, and we can talk about a little bit about what are those impacts on local governments and how we look at environmental risk when we're assessing the risk of bonds for local governments. And lastly, feel free to ask questions throughout. I know there's a chat button you can ask questions to, but we'll also pause after each of the three sections for questions. So without further ado, we will have the state level update, and Matt.
Roger. Hi, everyone. Thanks for joining. As the introduction from me stated, I'm with our state's rating team. So I just have a couple slides, and I'll kind of talk through the state sector in general, and then I do have some specific information to present on the state of Kansas as well, and then would be happy to answer any questions that would come up in the meantime. But to just kind of think of our states and how they're responding, how they're impacted to the pandemic and the economic slowdown that resulted from it, and what recovery is currently underway. This slide kind of boils down the challenges and the exposure in 4 different fields. The top 2 speak about revenue and reserves. And I think on the revenue standpoint, states tend to have similar mixes of revenue, but with some exceptions, others stand out with regard to dependence on income taxes, dependence on sales taxes, and what role they might play in their budget. So clearly, exposure to certain types or dependency on certain types of revenue would potentially cause a disproportionate impact on a state's budget. The one thing I'll say about reserves is I think the key thing coming into the current slowdown is that states really were building up reserves very actively over the past several years during the economic expansion. And so if there's one kind of key message to kind of express with regard to state resources, it's that states really did prepare themselves for something like this. You hear reserves referred to as rainy day funds. Today is a rainy day if there ever was one. And states are tapping those reserves to some extent, but by no means depleting them. So those resources are there, they're available. States are making their own decisions on what to do with them, but it puts them on pretty solid footing to deal with these challenges. Moving to like the spending side, states just have a lot of flexibility in how they manage their budgets, and that can result in challenges being pushed down to other local governments, say if there are cuts in state aid or revenue sharing or things like that. And then I think the other thing that we kind of expect going forward, and we haven't seen too much yet, is changes in long-term liabilities. I think some states are at least preparing to bridge some of their budget gaps and budget deficits with borrowing, either on a short-term basis or long-term basis right off the bat. If there is short-term borrowing, states, we expect some might convert that into long-term borrowing. So there is an expectation that, over the next couple of years, we will see debt burdens rise. Over the last several years, debt burdens were largely held in check. States weren't borrowing significantly. So if this were to happen, we wouldn't see a material increase in debt burdens, but at the same time, we recognize that states have competing needs, investing in infrastructure and things like that. So to the extent borrowing to correct deficits could crowd out infrastructure investments, that might be a challenge down the road that states would have to grapple with. The next slide really focuses on revenue. Over the last several months, we've put out a couple forecasts on where we think state revenue is going. And in the aggregate, there's an expectation that coming off of FY 2020, where actual state revenue, again, in the aggregate was down a little over 5%, we are expecting that revenue could be down another 6% in fiscal 2021. So this is kind of treating all states having a July 1 start of the fiscal year, which is the case for all but a handful of states anyway. The important thing to kind of think about when we're talking about aggregate revenue decline is that this is in large part being driven by a handful of very large and very heavily impacted states. So you have New York, you have New Jersey, you kind of have the Northeast area in general, and then you have maybe the state of California. And those states have pretty high reliance on income taxes to sales taxes to some extent. They were also the states that, shut down the economies maybe earliest and most extensively. And so they've seen slower recovery in jobs, slower recovery in economic activity. And to the extent they're already contributing a very high amount of revenue to the general state revenue number, they're going to kind of weigh those figures down. But if you look across the entire sector, there are states right now that have been very little impacted by the pandemic. Some states that did not see dips in revenue at all whatsoever, and states that are recovering more rapidly than others, even if they did see big declines early on. And I'll talk about Kansas on the very next slide, because Kansas is one where, given the role that income taxes, and Roger, if you want to move forward, you can. Given the role that income taxes and sales taxes play in the state's budget, you would expect that a slowdown in economic recovery would have a very large implication for the state's budget, and that is the case. But at the same time, if you look at the figures through September for the general fund in totality, there's good recovery underway. You know, there's a lot of noise in the figures because of the shift in the income tax filing from April to July. But if you kind of do your best to normalize that, you can see that Kansas is on its way to recovering the revenue that was lost. And not only thinking through, you know, where today's revenue is compared to where it was the same months the prior year, it's also important to compare it to what the state's own expectations are, because that would drive a lot of, you know, budget adjustments or the use of reserves if things go south relative to the state's expectations. But the note I have on the slide here is that through September, you know, just 3 months through the fiscal year, but through September, general fund revenue is trending 5% above the state's own forecast. So to the extent Kansas was expecting that reserves would be spent down very low, that there might need to be some borrowing to bridge the gap or some additional expenditure adjustments put into place before the end of the fiscal year, there are positive variances already showing up in the numbers. Obviously, a lot of uncertainty beyond September. There's a lot of the fiscal year left, and so things could change. But as of now, things are trending positively. And this is kind of the case, again, in most states, with few exceptions. Most states are bouncing back and seeing revenue growth, revenue recovery, but also revenue, positive variances in revenue relative to their own budgetary expectations. So I'll pause there just to see if there are any questions on the state. You know, I could go into more detail just on the budget in general, but I kind of wanted to stay high level and talk about the revenue picture, economic trajectory for now, in case there were other questions that wanted to come up.
If you have questions, please use your chat button at the bottom of the screen or turn on your video and unmute and ask it live.
Matt, maybe a question for me, for maybe waiting for others, is it looks like with Kansas 5% above forecast, is Kansas or maybe other states, were they conservatively forecasting their revenues for fiscal 21? Or are they actually above kind of prior year? Just trying to get a perspective of what that 5% above forecast is compared to maybe actual for fiscal 20.
No, thanks, Roger. That's a good question. I think, you know, in general, we tend to see states and their budget offices approach any fiscal year fairly conservatively. Even during the economic expansion, you know, states didn't want to start a new fiscal year assuming that revenue was going to grow another 5-6% or so like that. Whenever budgets were adopted, unless brand new revenues were implemented or tax increases were implemented, most states tend to assume pretty slow growth in revenue. And then to the extent revenue comes in stronger than expected, it allows them to, you know, put aside money in reserves, make some one-time spending increases, investments in infrastructure, things like that. And I think the answer to your question is that this year was no different. That, you know, states were hit pretty hard towards the end or towards the close of fiscal year 2020. And as they sat down to, you know, some had already prepared their 2021 budget, so they were revisiting them, some still in the preparation stages. But as they were going through that, they assumed that, you know, there'd be a big hit to revenue for 2020, especially on kind of a cash basis or budgetary basis with the income tax shift. But then I think there were a lot of conservative assumptions built in on how income taxes would actually come in once they were filed in July, how sales taxes would perform, not only for the next few months, but just through the rest of the year. And so states, when they're developing their budgets, they want to be prepared. They don't want to be surprised in the negative direction. They'd rather be surprised in the positive direction. So I think that's just a general tendency. And there was really no deviation from that tendency with fiscal 2021 budgets.
Okay. Well, if there are no other questions, we will move on to Ken, giving an overview of the local government credit landscape. Ken.
Yeah, thank you. Good morning, everyone. I'm glad you could join us this morning. So what I want to do is just kind of walk through a little bit of what we've seen in Kansas over the past year in terms of the cities and counties that we rate, and sort of give you a high level overview of how the state's performing. So on this slide here, what you can see here is a lot of information on the screen, but what you can see is that we rate 33 cities in the state, and really the credit quality of Kansas cities is fairly strong. 60% of the cities that we rate, they're rated by Moody's, are in the AA or higher rating category, and the national median for cities is AA3. So you can see here that obviously most of the credits are on the left-hand side of the bar graph, and then the others are on the right-hand side. But the credit quality overall is pretty strong. Kansas City's also, and so what I've got here in the chart below is information from our past couple of government median reports that we've published, and this is comparing Kansas City's to the national medians. And so nationally, Kansas City's compare fairly well. They have shown some improvement in fund balance and liquidity metrics relative to the nation, though cash tends to be slightly weaker than the national median. This gap has closed some in recent years. So for instance, in 2017, the gap was about 10.5 points. And in 2018, it was a little over 7 points. And so we don't have the 2019 medians published yet. And part of that is because of the audit schedules for other states where, and Kansas too, where some issuers don't end their fiscal year to the end of 2019, and so it tends to take a little bit longer to get some of those audits in. But I would expect that this could close a little bit more in 2019 because the fund balances have risen in the state of Kansas for cities overall. So I would expect that again that gap would close a little bit. But there is some divergence in our Kansas cities from the national metrics, and one of those is in terms of debt. So Kansas cities are generally twice as leveraged as their peers. And that's, both in terms of debt to full value and debt to operating revenue. And some of that divergence, there is some reason for that. Some of that divergence is just sort of a combination of smaller tax bases, which you can see. I mean, Kansas medians are generally 70% or so of the national median in terms of tax base size. So certainly, even if you're issuing the same level of debt, your debt to full value is going to be higher. So that's a factor in that. And then we also have just sort of a smaller sample size, right? We have 33 cities here. So that sample size is going to affect that to some extent. But leverage overall in terms of debt and pensions combined generally is higher than the national median. But across the state, really stable ratings across the state. For the 33 cities that we rate, we've only had 3 downgrades since 2018. So again, just really a very stable performing sector. And then in terms of counties, on the next slide, so we rate 14 counties throughout the state, 14 out of 105, so a smaller sample size. But similar to cities, the credit quality of Kansas counties is really strong as well. I mean, 64% of the counties that we rate are in the AA or higher category, and the national rate median for counties is AA2. So Kansas, again, performing fairly well, at least comparable to the national medians. And counties in Kansas, they tend to be all around smaller than their national counterparts. Tax base is about half of the U.S. median. Reserves and liquidity are slightly weaker, and the debt is a little bit above average. But overall, again, compares fairly well. So from a risk perspective, total leverage, again, in terms of outstanding debt and adjusted net pension liabilities is in line with the nation, and even perhaps a tad bit better. But again, counties are also performing fairly well. So in terms of sales tax collections, what this chart shows here is that sales taxes have also were performing fairly well prior to COVID, and we'll talk a little bit about COVID. But coming out of the recession, sales taxes were doing really well in the state of Kansas. So what this chart shows is this chart shows the state collections in each county. So this is not a distribution to the individual taxing entities. We use the counties in this instance as a proxy with the assumption that sort of the city and county distributions would match, or at least closely follow the trajectory of the state collections. But there are obviously some individual variances within the distributions that could cause some difference there. And so statewide sales tax is a really good measure of economic activity. It's a little bit more consistent than the distributions, which could be thrown off by timing and sort of some other things. But it's a very consistent barometer here. And so there tends to be some noise in those distributions, again, that come from the state for various reasons. So the dark blue bars here, what this represents is we went back and looked at, out of 105 counties on a month over month or a year over year basis, how many counties were up in terms of total collections to the prior year, how many were down less than, between 0 and 5%, and how many were down more than 5%. And then we have a median change. And so what you can see here is that really year over year collections, again, counties that have seen growth has been fairly stable. Now 2011 is a sort of an anomaly because the state increased the rate 1% in 2010. But coming out of the recession, again, collections were really very strong. Again, aided in part by that increase in 2010, another one in 2015, which is a little less than 0.5%. But what you can see here is the strongest and most consistent median growth really was in the past 3 years, 2018, 19, and then so far in 2020. So despite the pandemic, 64% of the state's 105 counties have posted increased collections through July. And that's really a remarkable number. When the pandemic started, I think the consensus was, at least in talking with some of you and issuers in other states, that sales taxes were really going to be impacted. That was the fear. And we haven't seen it materialize to the point that we initially thought. That the consensus was that we initially thought we would, which is a positive for credits, cities and counties particularly, that are a little bit more reliant on sales tax collections to fund operations. And so we only have, out of the, again, 105 counties, 81% are either positive for the year through July, or have seen a decrease of less than 5%. 5% I think would generally be within a margin of error that you can adjust operations to. Anything over 5% starts to get a little pressured again, but that is somewhat dependent on how you budget, which tends to be fairly conservative in the state of Kansas. But so through July, total collections statewide are down less than 1%. It's about 8% or 0.8%, excuse me. But positively, the median is up a little over 5%. So through July, collections are doing really well. So on the next slide here, what you can see is that we have 7 counties in the state that are really driving economic growth. Douglas, Johnson, Reno, Saline, Sedgwick, Shawnee, and Wyandotte counties. So in those 7 counties is 58%, a little over 58% of the state's total population, and about 66-67% of all state sales tax collections. Obviously, Johnson and Sedgwick is where the population centers are at, and those are big contributors to the state as well. And these 7 counties, with the exception of Saline, we don't have a rating on Saline, but they tend to be very highly rated counties. Yeah. And so then on the next slide, you can see a little bit about that, about how these 7 counties really contribute to the state's economic development. So what this chart shows is it shows the population growth in these 7 counties and then the state as a whole. And what you can see is there is a divergence in this trend. Without these 7 counties, without the population growth that these 7 counties have experienced over the past several years, the state's population would have actually declined, would have shown a decline. So it would have been about 37,000 residents since 2012. So since these 7 counties have added 64,000 to their population, the state's added about 27,000. So these 7 counties are really driving a lot of development, which is to be expected to some extent. And the trend is also accelerating. So in 2013, the difference, these 7 counties were about 132% of the state's population growth. And really what that means is that without these counties, the state would have seen a loss in that year, but that number increased to 234% in 2019. So it's that trend in these 7 counties that the populations are really becoming more urbanized and less rural. And certainly Johnson and Sedgwick, again, are drivers of that growth to a large extent, are performing as expected. But, Douglas and Wyandotte counties are doing really well as well. They're strong contributors to this. Douglas County has added a little less than 9,500 residents since 2013. So it's about 8% of the state's total growth. And Wyandotte's added a little over 6,000 residents, which is about 4% of the state's growth. So it's not just the 2 counties that we would tend to think of as driving, but the other counties are experiencing some fairly significant growth as well. So on this next slide, in terms of sales tax collections, again, one of the things that's really positive when you do have population growth, to a large extent, population growth can drive prosperity. And what this chart shows is the per capita growth in sales tax collections. And so in these 7 counties, so the statewide average is $125. So from 2013 from 2012 through 2019, per capita collections in the state grew $125 per resident. And what you can see on this chart is it shows, again, individually these 7 counties. So Saline, Sedgwick, Wyandotte, Johnson County were all above this $125 metric. But what this really shows is why this is important. Obviously, in these counties where you have growth, property taxes certainly expand, but where you have the greatest sort of expansion is in sales tax collections, retails, restaurants, hotel, motel, entertainment venues, tourism, those kinds of things that really drive revenues. And again, because to Matt's point earlier, conservative budgeting, generally, in my experience over the past several years in working with you all and other Kansas cities and counties, that budgets tend to be fairly conservative. And so we're not budgeting for this growth. So when this growth comes in, it certainly is a positive. But sales tax revenues tend to account for about 1/3 of local government revenue nationwide. Property taxes, another 1/3. Certainly there's some variance within that across the nation, but per capita sales tax collections is indicative sort of economic activity. It isn't only rooftops being added, but like I said, retail, restaurants, entertainment. And rooftops do drive the need for public services, but the ability to capture these additional revenues outside of property taxes is certainly positive. And many of our Kansas issuers, which doesn't show up in this chart, because again, this is just the statewide collections, they do benefit from specific voter authorized sales taxes for various operating needs, right? Parks, police, transportation, health, pensions. And so you are able to capitalize on this growth to sort of fund operations. So in terms of COVID, COVID certainly created a variance. This variance is not outside what we saw nationwide in April, May, and June. What these bars show is that the median change by county during this time, really starting in December through July. So the gray bars are the the gray line, or the green line, excuse me, is the year-over-year change in total collections. And so statewide collections in April certainly took a hit. They were down 15%, but again, well in line with what we saw on a nationwide level. They recovered in May. They were only down about 0.8% in May. And then they recovered strongly in June as sort of the economy started opening back up. But the median county collection fell about a little less than 3% in July, but total state collections were positive. And then again, the median county collection decline, it can be attributed to a lack of, typical summer travel, vacation, tourism, sports tournaments, which are really big in Kansas, people staying indoors, just sort of the lack of overall activity because of the pandemic and the economic shutdown. But with the exception of July, these figures are really in line, again, with what we've seen across the nation. Sales tax revenue, while impacted, didn't fall by the initial 40 to 50% that was expected or initially feared when the pandemic set in. So year to date through July, state collections again are down a little less than 1% overall, a very manageable decline. And as we've worked with many of you over the past several months, this trend is consistent with what we've seen from issuers. So again, pretty in line with the nation, and then individual issuers are experiencing very similar trends, some better, some worse, but generally in line with what we've seen across the nation.
You know, one thing, Ken, if I could just add to that, you know, I think at Moody's, when we were thinking about, you know, where is the economy going back in kind of March, April timeframe, I think one of the things that was probably very surprising was the very high level of federal stimulus. And so, you know, in trillions of dollars. And so as those trillions of dollars rolled into the economy, a lot of those dollars were spent very quickly, especially those dollars that went to unemployed workers that got the extra $600 a week kicker. A lot of those jobs that were lost were jobs that were in the lower half of the overall, you know, compensation scale. And so that's just to give you kind of a perspective there. It's, you know, we're not talking about the future here necessarily, but just back in that kind of April timeframe, then May and June, when those dollars really started to come in May and June. That's one of the reasons for that, you know, nice pop that we saw there. And of course, Ken, I think already talked a little bit about after June, but
yeah.
Okay.
Yep. Yeah, absolutely. Okay, so this is an interesting map, and really what this map is, it sort of shows the urban-rural divide. You know, 2020 collections are faring fairly well, you know, despite the pandemic. But what you can see from this chart is that really the more rural western half of the state has more declines than the eastern half. Now, the interesting thing about this chart is that some of the declines on the eastern half are much larger than the western half, and I think some of that can be attributed to, again, to some of the job losses. It can also be attributed to the strength of ag that happens in the western half of the state. But the major population centers are down or flat for the year. Some of the counties that we mentioned earlier, again, are down or flat for the year. You can see where some of the really strong growth is happening sort of in the Atchison, Jefferson, Leavenworth area. And Sedgwick is pretty flat for the year. And then again, you can see in the sort of the western half of the state that you know, we have a lot more negatives on that side of the state, which is to be expected to some extent, given that people were staying indoors. Again, you would expect more of the big box retail, restaurants, some of more of the sort of essential shopping experiences to be in the more populated areas, but there are strengths certainly in the western half of the state as well. But these counties, the counties on the eastern side that are more popular, they have an outsized pool, sort of on the statewide collections. And again, you know, one thing that's positive about this is on paper that declines or the trends may look a little bit worse in Kansas. And part of that is because a lot of the counties in Kansas were coming off record collections in 2019. 6 of the 7 counties that I highlighted earlier were coming off of record collections in 2019. So while we're talking a little bit of a downturn relative to the prior year and prior years, you know, it's sort of exacerbated by the fact that the prior years were really, really strong. And so that's, you know, you kind of have to take that with a, you know, kind of balance those out. But 2019 was also a record year for the state in terms of collection. So not outside of what we would have expected to see, but an interesting chart nonetheless. And then in terms of unemployment, so unemployment is recovering. Kansas certainly got hit hard initially. Some of that started before sort of COVID came in. With some of the experiences that Boeing was having, some of the downturn in aerospace manufacturing, but the state has come back, and most of our issuers are coming back. Jobs are returning. Certainly, as the economy has reopened, those jobs are coming back. But you can see again, you know, on the western half of the state, while sales tax collections may have been down a bit in some of these counties, unemployment is really strong in the western. You know, the ag part of the state is performing very well. job losses are not in those areas, so to speak. But aerospace, hotel, motel, tourism, non-essential retail, manufacturing took a hit at the beginning of the pandemic. Those slowdowns certainly impacted some of the more populated counties. But again, a lot of those jobs have come back as the economy has reopened. But, you know, as we look sort of towards the future, what we'd expect, the pace at which the pandemic is brought under control, and this applies to everywhere, not just Kansas, but certainly the pace at which the pandemic is brought under control, or the pace at which we learn to live with this, it's going to dictate sort of future recovery. Though we do anticipate that cities and counties, consistent with past practice, will adjust to sort of whatever the new normal is. You know, you all, what I've seen over the past several years in working in the state of Kansas, the budgets again tend to be fairly conservative. Cities and counties tend to be very quick to adjust to what's happening around them, and I don't think we would expect any deviance from that activity. So with that, I'll pause. Are there any questions?
Yeah, I know we have one in the chat.
There's one question in the chat is, in your opinion, if a city was going to implement financial matrix, what would you recommend measuring to assist with improving their rating as well as their financial stability?
Yeah. So, or do you want to answer? You want to go, Ken?
No, go ahead, Roger.
Yeah. So I'd say on that, you know, we, you know, Moody's, from the analytical side, we don't provide, you know, counsel or advice. That's something that it's just with the regulators we can't do. But what I can say is that we have all of our methodologies are on Moody's.com. They're all, you know, available to the public. And whenever we have, you know, rating come in, we confirm which methodology that security would be appropriately looked at, and we base it on our methodology. So what we also try to do is for several of our methodologies, not all, but some of them, we put out medians. I know, Ken, you put out you know, screen earlier, for example, cities, counties, and school districts. Every year we put out medians. For water and sewer, we also put out medians. So that's a lot of what the local government space is, and also some other sectors we do too. So that's probably one of my best answers to that is looking at our methodology, seeing how we assess risk, and then seeing how different you know, overall AA, AAA, single A, kind of broad bunches of credits, you know, what the medians are for those. So I don't know if that best answers that question, but that's.
You want to mention the RES, Roger?
Yeah, and so there are different products available. You know, I'd say reach out to, you know, Peter Glick. There's a rating assessment service that's available. There are indicative ratings that are available, of course, public ratings. So we have all different types of products available depending on what your needs are. But connect with Peter on that. Okay.
All right.
So I will take it over from here. So I wanted to close just talking a little bit about environmental risks. So at a high level, y'all, or probably several of you have heard about Moody's talking about ESG, environmental, social, governance. While we could talk about, you know, all the three letters, you know, of that today, right here today, really wanted to focus more on the environmental risks, especially because our partner 427, our Moody's affiliate 427, 3 weeks ago, spent an entire presentation talking about the environment and ways that that affiliate reviews risk, I wanted to take basically that presentation and bring it down to a local level. Some of that will be in the back half of this section, but definitely wanted to kind of expand on what Lindsay was talking about a few weeks ago. So we think of, what is environmental risk? When we're thinking about, ratings and, especially for local governments, we think about what are those adverse effects of very direct environmental hazards, and then what is the interplay of the regulatory or policy initiatives, and what do those initiatives seek to do to try to prevent or mitigate environmental hazards. This is a risk that's growing, facing pretty much, I would argue, almost all issuers. Some issuers, it's very apparent to. Other issuers, it might be, very, very minimal. There is very, very much a growing investor interest in this topic. And weather-related events can cause lots of different disruptions, for issuers. And we'll talk about this a little bit more, some more specific examples, but reducing revenues and very extreme events, they can cause about weather-related events have become more frequent and severe. That is demonstrated on this chart. It's something that we put out a few years ago. And it's basically just says, overall natural disasters are coming in a lot more frequent. I think of, this only goes through calendar 2015, but I think of how many storms were in the Gulf of Mexico this year and in the Atlantic, a record number of named storms. As we're, I think, into the Greek alphabet already this year, with Zeta coming into New Orleans today and yesterday. So a lot of this on the increment has been floods. Now, a lot of floods from what we look at, they're generally, they have been manageable by local governments, historically, but thinking about the entire interplay of all of the different disasters, that's something that we are constantly looking at, thinking about. Analysts might be asking you questions about that on rating calls. Here, just kind of think about credit ratings and the time horizons. We can only go out so far as analysts about long-term risks. We have a really good view, we believe, in near-term risk over the next several years. But as that time frame really extends, it's harder for us to really understand what that impact will be on that local government. And the reason I say that is because every local government reacts differently to different environmental risk on the margin. And so as we try to think about a static environment going out 5 years for some environmental risks, that doesn't work because no environments are static. Pretty much all environments are dynamic. So that local government might take some mitigating measures, might spend money to for capital improvements, whatever that is for that risk. Might have different governance parameters, might have raising the amount of reserves to deal with the potential risk of an environmental catastrophe or something happening. So that's a dynamic risk that it's hard for us to have very long of a time frame to view. So we're really good at measuring that that short-term risk. But clearly there are some risks for some cities that, if they're constantly being hit by hurricanes, which is clearly not the case with Kansas credits, then those are more endemic risk. But again, that's more on the tail of all of our local governments that we rate. Going to the next slide, thinking about, how do these risks inform our key rating factors? So this here I have economy and tax base, finances, management, and debt and pensions are the 4 key rating factors in our general obligation methodology. We do, of course, have other methodologies, but this is by share the majority of the credits that we rate or geo credits in the local government space. So thinking about economy and tax base, climate shock can weaken the output and the tax base valuation. That could impact the issuer's revenue base. Some, some municipalities might have a higher reliance on property taxes than others. So seeing what that interplay is something that we think about and discuss. Finances, how much flexibility is there in reserves to handle unanticipated emergency response costs? Infrastructure repair costs, some of that infrastructure repair costs might be bonded out. And so that'd be on the debt side. If it's really quick and it needs to be, as we call pay-go, that would be coming out of on-hand cash. And that, of course, could negatively impact finances. And, going down to debt and pensions, clearly we've seen situations where debt can be, going up because of infrastructure needs. If a municipality already has high pensions, which overall, and I know that's probably a separate topic here, but we have written extensively about how pension burdens across local governments have continued to rise. And so if you already have high pension obligations, adding on a higher incremental debt obligation, that overall could increase the risk to bondholders, and that would be reflected in our ratings. Couple aspects here, difference between climate trends and climate shock. Trend is something that reflects very gradual changes in climates over a very long period of time. Pretty much within our ratings, we do our best to incorporate climate trends, but often what we see is there is a climate shock that is, causing some situation, either a change in reserves, as we discussed earlier, or maybe to have a, infrastructure mitigation plan over something that's, happened over the, the near term. So debt needs to increase, but just differences between climate trend and climate shock. And then on the following page, we just wanted to give an example, kind of more of a graphic. So we spend a lot of time, I'd say, in committees and just overall as analysts, talking about, climate shocks. What are the climate shocks that have happened more recently for that municipality, really for that area, maybe for that region of the, the state or the country that we're looking at? When I think of, population displacement, example of that, again, not in the Kansas region, but, I think of New Orleans and how after Hurricane Katrina, there is a, over 100,000 people have left. Population hasn't come back to the levels of 2006. So with those population displacements, what does that mean for the overall ability of that municipality to provide essential services to its residents, which is overall what, we view as, the main reason for local government's overall existence. And here is a little bit of an expansion of what I've talked about already, but example of how climate risk can be transmitted to credit risk. And so, think about warmer temperatures, and that's that overall, trend of climate trend versus climate shock. So warmer temperatures is more of an example of a climate trend that generally happens. There can be climate shocks, right? In 1 year, you can have very warm temperatures, but what is the trend? And I think an example with Kansas, thinking about crop yields. And so with a large, farming community, will crop yields be compromised? Will there be higher energy demands needed to deliver, certain output for, farming? And then what are those adapted strategies that farmers would need to relay into their, into that, their product. Now that's on the, call it the, not the municipal direct side, but that clearly feeds into that local municipality and what the revenues are ultimately for that municipality, and what the products and services that that municipality can provide. Overall, I think of this how it bleeds into the financial performance. If there are lower tax revenues, then that's just, I know Matt was and Kim was talking earlier about the, the revenues on both states and local governments. What is that feedback loop? And then what we've seen is that some municipalities are very quick on management, on the management side, and that would be governance. How quick are they to get in front of that, to manage their finances and to put in, different plans that can help maintain stability in the credit profile of that municipality. As I think about what's a very real-time example of environmental risk, I know I spoke about New Orleans, but positively, I think of Paulding County. So less than just inside 2 years ago, and this is in Ohio, we upgraded Paulding a notch to AA3 from A1. And in part, that upgrade was due to higher tax-based growth. And that was being driven by, in part, new wind farms. And we've seen that in, in how we, in the local governments that we rate. It's generally a smaller portion, but there are definitely some, some added benefits to the, the wind farms, and clearly depending on how those taxes flow through that municipality. Sometimes there's longer term abatement agreements, or they're not charging 100% of the incremental tax base. But nevertheless, we have seen, and this is a great example of Paulding County, some positives of environmental risk and how that can benefit the risk profile from our view. And then I'll kind of be closing on a few slides here just to show an optic about climate risk in U.S. counties. And so what this shows is that really in the Kansas, Missouri area too, but definitely Kansas area, exposure to heat stress is something that is very unique compared to the rest of the country. Other aspects as far as extreme precipitation, water stress, and of course cyclones, not as much, but heat stress is centered right in the Kansas/Missouri area. And so what you can see is with heat stress, a little bit on the water stress too, but you can see with heat stress, pretty much every county is red as far as high risk. There are a few counties, including Johnson. I have a graphic on Johnson in the next page that is at the highest end of heat stress. But when we think about environmental risk with Kansas municipalities, that's something that we, we will be discussing and, could be coming up in a, rating call. I'll skip this slide. This just goes into some of the aspects that we've already talked about climate impacts on local governments. But I'll finish with this slide. And it's something new that some of y'all might have seen, but this is on what we call our landing page on Moody's.com. So for example, this is Johnson County. So if you type in Johnson County, near the bottom of that page, of that very first page where it has the ratings, the reports, the credit opinions, press releases, it'll have this climate hazard risk graphic. And this is something that our affiliate 427, we've been able to incorporate into our analysis over the past year, or actually I think less than a year. So this shows Johnson County is barely in the red flag. Again, most of Kansas is just under that, and it's right on the edge of there with a score of 82. But heat stress affects energy demand, cost, can affect labor productivity. What is the grid reliability? That the reliability could be more compromised with higher heat stress. And so again, it's very typical for Kansas municipalities, but that's just the nature of where Kansas sits in the country. So with that, I will stop there and just see if there are any additional questions before we conclude.
Roger, are cities going to get this climate hazard risk table too?
Yeah. Well, yeah, so Peter, great question. So pretty much I think everyone I've seen, every city and county has this, and maybe there's some other sectors too, but every city or county that's rated by Moody's has this table on their landing page.
Okay. And is this something that the issuers are typically shown or informed of, or?
I think, again, it's new.
It's new.
So it's something,
So
it's something, right. It's something new that, we can talk to the issuers about. And so when things really stand out in that, if it's something that we feel like is, relevant for, the issuer in that situation, we might, bring up the topic. Clearly what we try to do is, ask questions that get to the heart of what the bondholder risk is when we're assigning ratings. So if it's appropriate, we do, bring up these risks.
Yeah, I think it's important for the issuers to realize investors that subscribe to Moody's.com, will see this and they may or may not ask you questions about it. That's very helpful and something everyone should probably be aware of.
Any other questions? I see none in the chat, but is there any last minute questions or comments? Okay, Ted, I'll turn it back over to you to conclude the session.
Leslie has a question.
Oh, okay, there we go.
Could you speak to cybersecurity risk, a different sort of environmental risk? Question mark.
So cyber, that is, that's outside of, that's a different type of risk. And so we definitely spend a lot of time, we've been writing a lot about cybersecurity risk. That's probably a longer conversation, but Leslie, if you want to connect on that, we can definitely speak about that in more detail to get you what you need.
And the second part of it is, were there any other environmental risks? Or question.
Sorry. A different sort. I'm trying to understand the different sort of environmental risk.
What I meant.
I'm not. Maybe Leslie.
She's on.
Sort of risk.
Leslie, say it again.
I said what I was basically saying is that cybersecurity is a different sort of environmental type risk. I mean, it's a threat. And I know we're doing a survey for you guys, so I didn't know what, we promise we will get it in.
Yeah, no, thank you. Yeah, I think when we're speaking about environmental risk, we're speaking about the natural environment. And so cybersecurity is separate from ESG, environmental social governance, that bucketing of risk.
No other questions, Ted? You're muted, Ted?
All the members of Kansas GFOA would like to thank Moody's for their long-term support for the Kansas GFOA and this conference. And I'd like to encourage all attendees to visit the website and check out Moody's company profile and really consider Moody's when they're going out to bond each year. Again, thanks Moody's, and I look forward to seeing you guys in future ones.
Thanks, everyone. Appreciate it.
Thank you.
Thank you.
Thank you everyone for attending. We hope that you come back at 10:15 for the next section on accounting and financial management services with Ben Hart at Baker Tilly. Thank you all.
Thank you.